Most people know Warren Buffett as one of the richest investors in history. But what makes his story extraordinary is not just the billions of dollars. It's the way he built them. No flashy lifestyle, no revolutionary invention, no overnight success. Just patience, discipline, and an almost obsessive understanding of human behavior. While the world chased trends, Buffett quietly mastered one principle that changed his life forever. Wealth is built slowly, but compounded relentlessly. And his journey began long before Wall Street even knew his name. Warren Buffett was born in 1930 in Omaha during the Great Depression, one of the hardest economic periods in American history. Money was uncertain. Businesses were collapsing. Fear dominated the country. But even as a child, Buffett became fascinated with numbers, business, and investing. At an age when most children were thinking about toys, he was thinking about profits. He sold chewing gum door to door, delivered newspapers, sold Coca-Cola bottles for small margins. And unlike most kids, he didn't spend the money. He reinvested it. That mindset would define the rest of his life. By the age of 11, Buffett bought his first stock, 3 shares of Citi Service Preferred. At first, the stock dropped, and like many beginner investors, he panicked. When the stock recovered slightly, he sold it quickly for a small profit. But then something happened that stayed with him forever. The stock later skyrocketed far beyond the price where he sold it. That moment taught him one of the most important lessons of his career. Patience creates wealth. It sounds simple, but psychologically, it's one of the hardest things humans can do. Most people want immediate results, immediate rewards, immediate success. Buffett learned early that emotional control matters more than intelligence in investing. And that lesson became even stronger when he discovered the work of Benjamin Graham. Graham was known as the father of value investing. His philosophy was radically different from the emotional chaos of the stock market. Instead of chasing excitement, Graham taught investors to buy strong companies selling below their true value. To him, the market behaved like a person with unstable emotions, sometimes irrationally optimistic, sometimes irrationally fearful. Smart investors, he believed, should take advantage of those emotional swings instead of becoming controlled by them. Buffett became obsessed with this idea. He studied under Graham at Columbia Business School and absorbed every principle he could. But Buffett eventually evolved beyond Graham's original philosophy. At first, he searched for cheap companies. Later, he realized something even more powerful. A wonderful business is better than a cheap business. This changed everything. Instead of constantly buying and selling undervalued companies, Buffett began investing in businesses with strong competitive advantages. Companies people trusted, companies with predictable growth, companies capable of surviving for decades. That mindset led him to investments in companies like Coca-Cola, American Express, and Apple. But Buffett's greatest investment wasn't a stock. It was Berkshire Hathaway. Ironically, Berkshire started as a failing textile company. Buffett originally bought shares because they were cheap, but the textile business struggled badly. Over time, Buffett transformed Berkshire into something completely different. Instead of focusing on textiles, he used Berkshire as a holding company to buy businesses and investments across multiple industries. Insurance became especially important. Why? Because insurance companies collect money up front through premiums before paying claims later. That gave Buffett access to enormous amounts of investable cash known as float. Most people never understood how powerful this was. Buffett could invest billions of dollars using money generated from insurance operations. And because he invested carefully over long periods of time, compounding began working at an unimaginable scale. This is the real secret behind Buffett's wealth. Not speed, compounding. Compounding is one of the most powerful forces in existence. A small amount of money invested wisely over decades can become enormous. But most people sabotage compounding because they become impatient. They chase trends, panic during crashes, search for shortcuts. Buffett did the opposite. He stayed calm while others became emotional. During market crashes, fear dominates investors. People sell because they want emotional relief. Buffett understood something critical. The market transfers wealth from the impatient to the patient. That mindset became legendary during financial crises. When markets collapsed, Buffett often invested aggressively while everyone else panicked. Not because he ignored fear, but because he understood that emotional reactions create opportunity. And perhaps that is what separates Buffett from most investors: his psychology. Buffett once said that successful investing is not about having a genius IQ. It's about temperament, the ability to stay rational when everyone else becomes emotional. That sounds easy in theory, but emotionally, it's incredibly difficult. When markets crash, human survival instincts activate. Fear tells people to escape uncertainty immediately. Buffett trained himself to think differently. He viewed market volatility as opportunity instead of danger. That psychological discipline helped turn him into one of the wealthiest individuals in history. But surprisingly, Buffett never became obsessed with luxury. Even after becoming a billionaire, he continued living relatively modestly. He still lived for decades in the same house in Omaha he bought in 1958. While other billionaires displayed wealth publicly, Buffett focused on simplicity. This confused many people. But Buffett understood something deeper than consumption. Freedom matters more than status. Money, to him, was not about showing power. It was about independence. The ability to control your time, decisions, and future. And despite his enormous wealth, Buffett consistently warned people about greed. He criticized speculative behavior, avoided hype, and ignored most short-term market excitement, because he understood that human beings are naturally emotional creatures. People become greedy during booms and fearful during crashes. The average investor often loses not because of bad information, but because of emotional decisions. Buffett built his fortune by doing what most people psychologically struggle to do: thinking long-term. Today, Warren Buffett is considered one of the greatest investors who ever lived. But his story is bigger than money. It's a story about patience in a culture addicted to speed, discipline in a world driven by distraction, and rational thinking in environments dominated by emotion. His life proves something powerful. You do not need to move fast to build extraordinary wealth. You need consistency, because wealth is rarely created through dramatic moments. It is usually built quietly, through small, intelligent decisions repeated for decades. And maybe that is why Warren Buffett's story continues to inspire millions of people around the world. Not because he became rich, but because he mastered something far more difficult: himself.